Hey everyone, welcome back to CrowdWise Academy. This is Lesson 5, the fifth and final of the Module 1 for early stage investing, and today we're talking about swinging for the fences, power law investing and crowdfunding. We also have some Level 1 and Level 3 investor courses, so head over and check them out at CrowdWise Academy if you haven't already. An overview of what we'll be talking about today. Is the venture capital adage of swinging for the fences true in crowdfunding? What is the power law for non-mathematicians? How to mitigate the impact of high failure rates that we've been talking about in startups, and 3 ways that you can implement a power law investment strategy in your portfolio. Whether or not you know anything about baseball, I would venture a guess that you've heard of Babe Ruth before. I want to quiz you on something. In 1924, do you know what 3 stats Babe Ruth was ranked number 1 in? Many of you probably know that he had the most home runs for the season, and also he boasted the highest batting average. But do you know what the third record is that he held? He had the most strikeouts. And this is something that from 1918 to 1928, he was ranked number 1 in strikeouts 5 of those years, and the other 5 years, he was still ranked second most in strikeouts. This is something that today is called the Babe Ruth effect. We'll be talking more about how it applies as we get into today's lesson. But first, let's do another quick example of failure and the potential path to success. I'm going to give you some hints, and I'd like you to guess who this famous historical figure is. At age 23, they lost their job, and they were defeated for state legislature. At age 24, their business failed. At age 26, their sweetheart died. Age 29, defeated for state house speaker. Age 34, defeated for nomination in Congress. Age 39, they lost renomination. Age 45, they were defeated in U.S. Senate election. Age 47, defeated in nomination for VP. And age 49, defeated again in the U.S. Senate. I think a combination of any 1 or 2 of these would be pretty devastating to the average person. But after this long list of failures, at age 51, this person was elected the 16th President of the United States. I'm of course talking about no one other than Abraham Lincoln, the 16th President of the U.S., and considered by many to be one of the greatest presidents that we have had. So what's the lesson that we're trying to show here in failure? It's that sometimes failure is not only to be expected, but it can actually be a necessary part of attaining the highest levels of achievement. And we'll be showing today that in startup or early stage investing, that also holds true. So when we say swing for the fences, that's a common adage in the venture capital industry. What does it really mean, though? Essentially, it's saying that you can't aim for singles or doubles, also known as small wins. This is because of that high failure rate in startups. Since failure rates are so high and you know that the majority of your investments will fail, the ones that succeed have to succeed big in order to give you positive financial returns. That's why it's telling you only to invest in potential home runs. But is this true, and especially, does it apply to crowdfunding? We'll be taking a look at some of that data and answering some of these questions today. First, a quote from a professor at the University of Colorado Boulder, who said, "The greatest shortcoming of the human race is our inability to understand the exponential function." Now, I'm not going to be able to make you an expert in the exponential function or power laws today, but we will give you a brief overview that will introduce you to the concepts. To understand the power law, you first should understand what a normal distribution is. So, what is normal in life? Many things follow a normal distribution. For example, perhaps it's the average weight of your favorite breed of dog. Perhaps it's the average height or weight of a large group of people, whether male or female. Or maybe it's some tolerances on some 3D printed or injection molded plastic parts that you had made. All of these things and others follow something called a normal distribution. Let's use human height as an example, and male human height specifically. If we plot on the x-axis male human height and the count of humans on the y-axis, then for any large enough sample size, you'll probably get a distribution that looks something like this. In the middle, around 5'9", has the most people, and then it drops off from there, as obviously having a male under 5'3" or over 6'3" gets to be more and more rare. Now, we can describe this using something called standard deviations. If the middle, around 5'9", where the white dotted line is the mean or the average, then standard deviations are represented by the red lines here at plus or minus 1. that would be 1 standard deviation. You can go on and have 2 standard deviations to 3, 4, even up to something like 6 sigma or 6 standard deviations that GE is famous for using. Standard deviations are important because they can tell us some information about the data set. For example, for a normal distribution, we know that 68% of all the samples are within plus or minus 1 standard deviation. So 68% of all human males would be between 5'6" and 6 feet in this example. Similarly, within 2 standard deviations, we know that 95% of the overall data would be included. So from roughly 5'3" up to 6'3", we know that 95% of human males would fall within that range. And you can keep going on and up. So let's go back to the original data set. Taking a look at this, you can fit a curve to that looks something like this. And that's called the normal distribution curve. Now, on each end, one of the characteristics of this curve is that the so-called tails drop off to 0 very quickly. So, how does this compare to a power law? Shown in green here is the normal curve that we were just looking at. And in orange and blue are 2 examples of different power laws, with a different value of alpha that we won't get into in this lecture. But just understand that the value of alpha determines how thick the so-called tail is. Now, whereas the normal distribution drops off to 0 very quickly on each end, the power law has an important property of that long or fat tail where it goes out, so although the probability is very small, it allows some very large values that are not possible with a normal distribution. To better understand the power law, let's go back to the height example for a second. We know that in reality, due to physics, human height follows a normal distribution that looks like this. However, for a thought exercise, what would it look like if human height followed a power law distribution? A professor went through this very thought exercise in a white paper, where he noted, "We would expect ridiculous facts, such as 10,000 individuals being as tall as an adult male giraffe, 1 individual as tall as the Empire State Building, and 180 million diminutive individuals standing a mere 17 centimeters tall." We know within the realm of physics this is not possible. But in power laws, for example, in financial returns, those types of outliers are possible, and they can have such a big impact on your returns that they cannot be ignored. Thus, while the limits of physics prevent the power law in some situations, remember that many things in life, including early-stage investing returns, are believed to follow power law distributions, not normal distributions. What are some other examples of power laws? Well, we already talked about financial market returns, but also city populations, solar flare intensity, citizen wealth, earthquake magnitudes, and many other examples as shown in this paper. Overall, Peter Thiel mentions that we don't live in a normal world. We live under a power law. However, as the quote early on showed, most humans don't understand or even know what a power law is. And that is the importance of why understanding the power law is so crucial to early-stage investing success. For more details on the power law, we're not going to get into them here because we don't have enough time, but you can check out our blog post, where we'll go over what is the power law equation, what other properties does it have, such as the Pareto principle or 80-20 rule, fractals, and what does that alpha mean that we showed. Also, the book Anti-Fragile by Nassim Nicholas Taleb has some great discussions about the long tail and its implications on human society. Again, head over to the CrowdWise blog and check out power law investing and crowdfunding blog posts for these details and more. What does the power law mean for investors? There's 3 ways that you can apply power law investing to your investment decisions. First, where normal thinking would say, avoid risky investments, power law thinking says, to get the home run returns, striking out failures are necessary. Second, where normal thinking would have you believe that each investment should have mediocre or normal mean returns, in power law thinking, you'll realize that your biggest 1 or 2 investments will return more than the rest of your investments combined. And third, in normal thinking, you might focus your investments on the best few opportunities, concentrating in on those. But due to power laws and the high failure rate of startups, you should understand the importance of spreading smaller investments among many quality businesses, giving you more exposure to that very small probability but very large outsized return. So, number 1, as we said, is don't fear failure. You need to rewire your brain. from normal thinking, which would say something like, I will invest in companies that I believe have the potential to provide decent returns and have a low chance of failing. No! You need to rewire that to believe in power law thinking, which says, I will invest in companies that have massive potential to return more than all my other investments combined, realizing that many of these can and will fail. So, what does this look like in practice? We'll go back to Peter Thiel again with his excellent examples in 0 to 1. He says this implies two very strange rules for VCs. First, only invest in companies that have the potential to return the value of the entire fund. This leads to rule number 2. Because rule number 1 is so restrictive, there can't be any other rules. Remember, investing to win versus investing not to lose can be the difference between success and failure in early stage investing. As we mentioned, the second way to implement power law investing in your portfolio is to invest only in high potential startups. You need to rewire your brain from normal thinking, which says, I will screen companies and invest in those that look the most reasonable and safest from an investment perspective. No, rewire that to power law thinking, which says, I will screen and invest in companies that have massive potential, realizing that failure is a part of the process and that the best investments may look stupid or crazy at first. That last line is crucial, so let's talk about what this looks like in practice. Mark Andreessen says, most of the big breakthrough technology companies seem crazy at first. PCs, the internet, Bitcoin, Airbnb, Uber, 140 characters. It has to be a radical product. It has to be something where, when people look at it, at first they say, I don't get it. I don't understand it. I think it's too weird. I think it's too unusual. Many angels will tell you this, that your best investments may look or sound stupid or crazy at first. If they didn't, everyone would be wanting to invest in it, and the valuation would be driven up. Thus, by definition, to be a good investment, you have to be seeing something that the rest of the investors don't. Third, and last but not least, we've talked about this in the Level 1 investor courses, it's the importance of placing many smaller bets versus one large bet. Rewire your brain from thinking, I'll focus my investments and concentrate them on the very few best opportunities. No, remember, going back to that distribution curve, if there's an extremely small probability of a very, very large return, you have the best odds of getting that not by investing in one or two, but by placing many smaller bets. Thus, rewire your brain to power law thinking, which says the more investments I make at a given quality threshold, or alpha as we showed in the chart, the higher my expected returns. Again, this gets much more into the math, so we're not going to cover it here, but head over to the blog post if you're interested in the math behind this. So, what does this look like in practice? Dave McClure from 500 Startups had this to say. Most VC funds are far too concentrated in a small number, less than 20 to 40 of companies. This industry would be better served by doubling or tripling the average number of investments in a portfolio, particularly for early-stage investors, where startup attrition is even greater. If unicorns happen only 1 to 2% of the time, it logically follows that portfolio size should include a minimum of 50 to 100 plus companies in order to have a reasonable shot at capturing these elusive and mythical creatures. Thus, you should be aiming for at least 10 to 20 startups to start. This is essential to reduce your risk of losing money in risky startups. The only important thing to remember on number 3 is that in light of that number 3, quantity does not make up for quality. Placing many smaller bets doesn't mean investing in every single investment that comes your way or that is posted to a crowdfunding portal. You still need to make sure that it's meeting rules 1 and 2. You must invest in businesses that have the potential to be a huge success. Also, it doesn't mean investing in every single deal that's posted to every funding portal. Thus, the challenge becomes finding the resources, essentially your time and the amount of capital, to be able to invest in enough quality businesses to be able to satisfy rule number 3. Okay, all this is great to know for angel investing in VC, but does it hold true for equity crowdfunding, and will it hold true for Reg CF? Well, unfortunately, we won't know that answer for sure in terms of Reg CF until a few more years when we see potential exits. However, we can take a look at some accredited investor or Reg D equity crowdfunding deals from the WeFunder website. We ran simulations that compared the number of investments versus the overall portfolio returns. This is based on the WeFunder deal data from 2013 to 2016 for accredited investors under Reg D. What we found was very interesting. As you can see, making more investments is especially crucial at the beginning stages, where your probability of less than 1x, as shown by the blue here, drops very quickly. As soon as you've hit about 50 investments, you have over a 95% chance of making positive returns and not losing money. This is from a dataset that had 119 startups. This assumed random picking and didn't assume any type of filters. So, for someone that was completely random in investing, this shows the impact of how adding more investments can reduce your risk of losing money, and actually increase your risk of getting 2 to 3x or even 3 to 5x returns. Looking at this another way, we can see how the number of investments that is in a portfolio compares with the overall return multiple. Here, we can see that as more investments are added, going from the 0 all the way up to nearly 100 investments increases the median portfolio return for this random startup investor. A third way of looking at it is the probability of each portfolio to return a minimum multiple based on the number of investments. To increase the probability of returning greater than 1x returns on the overall portfolio, it was crucial to have at least 50 investments for about a 95% chance or greater of returning more than 1x the invested capital. You can also see that continually increasing the number of investments in the portfolio also boosts the 2x and 3x return multiples. According to the WeFunder data, a portfolio of at least 100 investments has a greater than 50% chance of returning over 3x the capital. We can also take a look at what the returns of each deal was to see if the power law applies to equity crowdfunding. As expected, one of the deals alone, Zenefits, accounted for more than half of all the returns to the WeFunder portfolio. This is exactly as venture capitalists and Peter Thiel tell you, where one investment returns more than the rest of the fund combined. However, what do you think your odds would have been of choosing Zenefits correctly at the beginning out of 119 possible investments? That's why it's important to place many smaller bets. Predicting the future and knowing which companies and startups will succeed is extremely hard in the early stages when there's such limited data. So, what would this dataset look like if we removed Zenefits and kept all the other deals the exact same? As you can see, due to power laws, that one return from Zenefits, which accounted for over half of all of WeFunder's returns, would greatly hurt the overall performance of the portfolio. Thus, if you had decided, for example, to not invest in Zenefits because it seemed too risky or for some other reason, you would essentially have removed most of your chances of getting a 2 to 3x or above return multiple on your overall portfolio. This is why it's critical to make sure that you're placing many of those smaller bets compared to fewer large bets. Thus, while this is only an indication of what we might expect for regulation crowdfunding, it seems to indicate that equity crowdfunding will indeed follow power law returns. All right, congratulations. With that, you've finished the last lesson in Module 1 of the Level 2 courses. Take the Level 2 Module 1 quiz to test your knowledge and solidify all your learnings and lessons that you've gotten thus far. In the next module of Level 2, Early Stage Investing, we'll be covering the who, the what, and the where of Reg CF investing. For the who, it's the types of businesses that raise on Reg CF portals, and which type of business is the one that you should be looking for if you want to maximize financial returns. We'll talk about the what, and those are the deal terms and offerings. So we'll be talking about terminology, deal terms, discount rates, valuations, as well as different offering types. What do we mean when we say a SAFE versus a convertible note, or common, or preferred shares, and which one financial investors should consider, or which ones they should ignore. Lastly, we'll talk about the where, and those are the funding portals, aka the websites where Reg CF deals are posted. We'll do some comparisons and brief walkthroughs, and by the end of it, you'll be ready to sign up for your first account and start screening deals. I personally want to thank you for taking the time to go through all of these CrowdWise Academy lessons. If you're watching this on YouTube or somewhere else, head on over to academy.crowdwise.org and create your free account. You'll get access to all the learning resources and the supplemental material, such as checklists or other things we talk about in these lessons. If you have questions, or just to say hello, send me an email, brian@crowdwise.org. And lastly, share and connect with us on social. Here's our Facebook and our Twitter link. This is Brian. I personally, again, want to thank you, and please feel free to share this with other investors if you think it's been helpful to you. Go take that Module 1 quiz, and I'll see you back here for the next module when you're ready.